Hey, what's going on, guys? Welcome back to Duplex Built to Rent. My name is Juan Cristales, and we're going to be talking about what's happening in the news today. We had a Fed funds rate drop today, and we're going to see where the mortgage rates go. Right now, the most current data that we have is going to be from last week, Thursday, but we will see what happens. Some people are speculating the rates are going to go up a little bit. They may come down a little bit. Who knows exactly what's going to happen? We don't have a crystal ball. We're not trying to use that to decipher what we're going to be doing, but I'm going to show you how the mortgage rates impact how you refinance your duplexes. So here we go. All right, so let's look at this here. We're looking at the Fed, the 30-year fixed rate mortgage, okay? That's exactly what this is, okay? This here just basically tracks throughout the United States the average. So on average here, it looks like in January of 2025, January 16th, the rates were at 7.04. That was kind of the high for 2025. And then, we've had it drop down. It came down to like 6.6, 6.62, went back up a little bit, went back up a little bit in May, came back down again to 6.67 in July. Then we had another drop in August 14, 6.58. And we have a huge drop here down to 6.26 in September. And now it looks like we're going to be at 6.19. That's the most current data. That does say Thursday, October 23rd. Today is Wednesday, October 29th. So we're going to see. A lot of people are speculating different things, but we'll see what the markets do. They may go up a little bit, who knows. But let me show you something cool. So what we have here basically is just a quick mortgage calculator. But before we look at all this other stuff, I want to just kind of show you something real quick. I want to put my face right over so you don't get distracted by it. So we are going to look at the property, okay, the duplexes that we're building. We're going to assume that they appraise for 400. Let's say they appraise for 375, just for argument's sake. Okay? It appraises for $375,000. The mortgage company says, hey, look, we can lend you maximum at 80% of the value, because it's a completed project, right? You've already finished it off. It's got the certificate of occupancy. We are now at the place where we have to exit out of the short-term loan. It's a short-term loan for the construction. We're going to exit and go into long-term debt. So most debt service coverage ratio, DSCR lenders, will allow you to do 80%. It's standard, okay? Now, you can go less. You can go 75%. You can go 70%, whatever the case is. And this is what those numbers represent. So basically what this means is, like, if your duplex is appraises for $375, they'll lend you up to $300,000 maximum. But let's say that the duplex appraises for, I don't know, $380. If you want to copy the spreadsheet, please just let me know. I will gladly send it over to you. It's nothing super crazy. I can send it to you for free, no issues. Just let me know. So now let's say the duplex appraises for 380. They will go up to 304. And then, of course, we keep playing around with these numbers till it gets to like 400,000. Sorry, that's 4 million. And then they will land up to 320,000 at 80%. 75%. So as you go down, so one of the things I want to explain to you guys here is as you go down in this loan to value amount, the bank sees it as less risk. Okay, that's less risk. Now, we're going to be looking at this here. So if we look at the Fed funds rate for, the 30-year fixed rate for the average in the United States in January of 2025 is 7.04. This is top tier credit. And what that means is, if you have a 720 or above credit score, you have a good paying job, and you have money in the bank in savings, you would get a 7.04 for being a top borrower, okay, essentially. So I'm going to make myself small here so I can show you guys how these numbers are impacted by that. Now, we're going to go down to 375 just to keep this consistent for you guys and so you guys can see how the numbers are affected. So we're going to assume the property appraises for $375,000. That's 80% loan to value, and we're going to borrow the 80. Okay, now the 80%. So if we're borrowing the 80%, then these numbers have to match here, the 300 here and the 300 here, because that's how much we're going to be borrowing. That's the max. We're going to say that the annual rate is going to be 7.04 because that's what we saw, going down this line here. a 30-year fixed rate mortgage. We're going to assume that the property taxes are $4,000. We're going to assume that the annual insurance is going to be $1,900 per month. I just got a quote on a 2,800 square foot duplex, and the insurance for the year was $1,839. It's new construction. The insurance companies see it as less risk, so your insurance should be pretty low. The monthly P&I, which just basically means the principal and interest here, is going to be $2,003.97. That's what this number here represents. Just the principal and the interest. Now, we're going to take the monthly taxes and insurance. So basically, we're adding these numbers here. We're dividing by 12, and we're going to be getting this number. It's automatically done. Now, your new total monthly mortgage is going to be $2,495. That's the PITI. That's the entire payment. And what I teach you guys is to not do duplexes or not look for lots where they have homeowners associations. So you don't have to worry about the HOA. Now, so because of that, I'm going to keep it a little bit conservative because I've been challenged a little bit. It's like, oh, good for you, Juan. You have rents for like $1,600, $1,700 a month. That's fantastic. What we're looking at right now are rents for $3,000. So that means it's $1,500 per side. Remember, this is a duplex. So $1,500 per side, that's $3,000 total dollars. That means that the cash flow on this deal, which is basically going to be the $3,000 minus the PITI, is going to be $500. $500 of free cash flow. Now, the DSCR, the debt service coverage ratio, the DSCR, basically is how much does the rent cover the principal and interest, the mortgage payment, basically. How much does it cover it by? So it's a factor of 1.2. So all we did was divide the rents by the mortgage payment, and that gives us 1.2. Now, the bank that we're using, and I'm going to do an interview with this guy, is okay with a 1.1 debt service coverage ratio, okay? But we're at 1.2 here, which is good for us, right? We're at a bigger ratio than they want. The challenge we have is that we're already at 80% loan to value, so they're not going to lend more than the 80%, okay? Now, if this was $400,000, and remember, this is in January of 2025. Let's say the property appraised for $400,000. They're saying that they would still lend us up to $320 if the property appraises for more. So let's input $320 here. And what that does is that allows us to borrow more than what it costs us to build it, even with the higher rate. Even with $3,000 total gross rents, $1,500 per side, we still have $370 in cash flow, and we're still in a 1.1 DSCR. All that means is that the rents cover the mortgage by a factor of 1.14, which still sits within the parameters of what the lender wants, okay? But that's because it appraised for more. But we're going to keep it at 375, just because I want to be fair to everybody and just say, hey, look, let's not get too overambitious here, okay? Now, next, what I'm going to show you is what today's rates are and how it affects it. So I'm going to bring this back down to 375, like I just said. Borrow $300,000. Now, the mortgage rates are now 6.19. Still a 30-year, I don't know why that's a dollar sign, my bad. That's a 30-year mortgage, and still the same property taxes, still the same property insurance. Now the monthly P&I are $1,835 as compared to what we had here, $2,137. So we got a big drop. The taxes and insurance are going to stay the same because that doesn't matter. Now the mortgage payment, the entire payment, the PITI, which is the principal, the interest, the taxes, and the insurance, now come up to $2,327.13, which means that our cash flow is now increased, and now our DSCR is increased even more to 1.29. So the bank sees this as a much lower risk loan, because you have so much rent coming in, or not so much, but you have so much in gross rent potential that it's covering the mortgage by a factor of 1.29. So as the factor goes up, that means you're covering the mortgage by that much more. So now let's take a look at this here. We just had a huge drop, right? Now I'm expecting this one that I just did, because it's a larger square foot property, for it to appraise somewhere around $420,000. That's what I'm expecting. Maybe more, maybe less, who knows? The bank says we can lend you up to $336,000. Now we borrowed $250,000. Okay, it costs us a little bit more than $250,000 to build it after we bought the land and everything else like that. But if we are able to, if this property appraises for $420,000, we're able to borrow more. We're able to borrow up to 80% of value, which is going to be $336,000. You see how that goes in there. And let's see what that does to our cash flow. It brings it down to $452,000. Still not bad. Still, $450 in cash flow. And our DSCR is still above 1.1, which is the minimum threshold that the bank is willing to accept. Okay? Now let's play with these numbers a little bit. Let's say that the property appraises for $430,000. That means that the bank is willing to do $344,000 at 80. That's 80% of value, and we're still at 1.16. So if, let's say, the property appraises for even $450,000, and the bank is willing to lend us $360,000, because the rates are so low here at 6.19 in comparison to what they were earlier in the year, right? Not in comparison to like the last 5 or 7 years or whatnot. So we're still at a 1.10 debt service coverage ratio. We're still making $300 total in gross rents based off of these numbers here. And if you look, we can borrow up to $360,000, which means we would be able to pay off the $250,000 and then get $90,000 of our money that we have in the deal. We don't have that much into it, but we get more back than we actually cost us to build the entire thing, and the cost of the land. Isn't that wild? That is absolutely wild. And it helps. I mean, if the appraisal comes in high and the rates are low, this is what really helps you and what makes these duplexes so much cooler. And let's check this out. The 1.1, as long as we're above a 1.1, that's all the bank cares about. The bank considers this a low risk loan. Why? One, because we have 80% of value. We have, if it's worth $450,000, they're saying, man, we still have $90,000 in equity on the deal. So that's still considered a low risk deal. And we also have a 1.1 DSCR, which means that the rents are covering the mortgage by a factor of 1.1. The bank says we're still good. We have to show some cash reserves in the bank, don't get me wrong. But if we're going to be getting $90,000, we should be solid. So we'll see where this particular property comes at. I'm going to show you this property next here in a quick video. So check it out. All right, so here we are at the property. Man, and listen, we get so much trash out of these things. It is absolutely bonkers. Those things are all full right there of just trash. We got everything pretty much done. We are waiting to get just some of this stuff cleared out so we can just go ahead and clean it, give it a really good cleaning, and wait for the appraisal to come in, and we'll be moving from there. Oh, I wanted to show you guys something really quickly, man. These are the types of doorknobs that we normally get. So check this out. This is a handle doorknob for the top, for the actual cabinets. And these are for the doors. There's some doors that don't have like actual doorknobs because they're like the doors for the pantry and stuff like that. So these are just two different types that we get. And, just wanted to show you guys that real quickly. And I also wanted to show you this little doohickey. You guys probably have an idea what this is. This thing here is actually a door stop. And this little hole right there is going to be for the hinge. So you put it inside one of the hinges in the door. So you take off the little metal thing that holds the hinge together, pull it out, put this thing in, and put the hinge back in, and then it should be good. But that's a door stop where you don't really have the opportunity to put a floor one. So that's pretty cool. The house is looking great. It's looking clean. Everything is looking awesome. We're coming together. And then now I'm going to go down to the other side real quick. I just wanted to show you guys how it looks. Super nice and sunny day today. Looks great. I love my shutters. They came out fantastic. And there's more trash, guys. Believe it or not, I have to use a trash can in another job site to get all this stuff in there. We had the floors covered up, all this other stuff, man. And listen, you think you're done with these duplexes sometimes. You got to have a little bit of budget left over because there's always something else that pops up. Here's something else that popped up. Look at this big, massive tree branch right in the middle of the driveway here. We have to figure out a way to, scale a ladder or something to cut this off somewhere over here to get rid of it, kind of clean up this tree and do some of that stuff. But this, man, this thing is coming out really, really great. And I will keep you guys posted on what it comes like. Oh, people are ask me like, why don't you just take that tree down? Well, you can't, because look, you see how the property boundary line is right here? So this is the property boundary line, right? Oops, sorry about that. The property boundary line is right here, okay? So if you see that, I'm going off of the fence that we have here on this other side. So if you notice, we can only put the wooden fence up to the property boundary line where we are, what belongs to us. So basically, all this other stuff here, this all belongs to the city. So if a tree is right here, we have to get their explicit permission to just be knocking down trees. The city does not like it when you start knocking down trees. So if you look this way, basically what we're looking at here is the property boundary line is going to be somewhere around right here. All right. So this tree is in the city's basic jurisdiction. Yeah, we have to maintain it and stuff like that, but we can't knock this tree down. I know it's kind of a little bit of a weird looking tree, but it's got to stay. All right, guys, those are all of the updates I have for you today. Thanks so much for watching. Let me know if you want a copy of this Excel spreadsheet. Happy to share with you guys. I'll talk to you soon.